Greetings, everyone. This is Randy Schwimmer, reporting from Zurich, Switzerland. So our connection is on the visual side is not as great as I'd hoped, but frankly, no one cares what I look like. What people care is what our panelists look like. Everybody sees me every week. So what matters is our guests. And boy, do we have a great group of guests to talk about probably a topic that is of high degree of interest, given the number of registrants, over 600, which is a record for Lead Left Presents webinars. This is our third overall, our second M&A conference. Justin Abelo, Managing Director of Houlihan Lokey, who was with us at our first. Justin, you'll always have that distinction as being the first on our call and the second. But we decided that we were going to include some additional heavyweights to Justin on the call. Michael Butler, Chairman and CEO of Cascadia Capital. Adam Gifford, Managing Director of Lincoln International. Bruce McDonough, Co-Head of Global Investment Banking at Baird. And Adam Tyndall, Managing Director at BlackArch. Gentlemen, thank you very much for being with us. So we are looking at a very interesting year ahead. And one of the things we'll want to do is get your questions. And we've decided to put a few poll questions as tests up. And they will be on the right side of your screen during the conference. So no hurry to answer them, but over the next 60 minutes. Justin, you were with us a year ago. It's amazing how fast a year has gone. What happened since you saw us last?
Yeah, thanks, Randy, and a pleasure to be back. As far as 2022 goes, when Roman generals were driven through the streets of the Eternal City after big triumphs, while the people cheered, there was a charioteer, an Origia, who whispered in their ear, "Thou art mortal, thou art mortal." For M&A professionals, 2022 was that charioteer. 2021 had been an amazing year. I think some of the people on the panel here were probably beginning to commute to work by helicopter. One or two of them might have dated Kardashians. I'm not sure. My subscription to the Post had lapsed. It was just a great year. But starting in around February of 2022, market activity began to gap down on a year-over-year basis. Global M&A activity fell around 35% by value, around 11% by count. U.S. activity fell even more, 41% or so by value, around 17% by deal count. Sponsor activity was a slightly more nuanced picture, but it was down as well. U.S. sponsor-related activity declined, less than the overall market by around a third or so on either count or value, although it did remain above 2020 levels. All of this driven by some of the things that we know about: an aggressive rate tightening cycle at the Fed, material tightening in the financing markets, resurgent inflation, supply chain issues, et cetera. But I think equally important are some things that didn't happen last year. Transaction multiples did not materially decline, at least for the deals that actually got done. LDC data shows that U.S. LBO valuations for the year actually exceeded 2021 multiples. Why is that? I think it's an old answer, which is selection bias. The deals that got done tended to be deals for extremely good and extremely financeable companies. Strategics have not been running the table in M&A this year. That confounded a lot of prognosticators as well. Sponsor share of M&A per Refinitiv was the second highest ever last year. Public to privates have not made some sort of glorious return, carried on the shoulders of Paul Cravath down Wall Street. Although they're like great books, they're probably being more talked about today than actually done. Pitch counts, our most reliable forward indicator, and a proprietary one, did not decline. In fact, our sponsor pitch count increased substantially year over year, suggesting to me that none of us should be planning any major vacations for the coming months. So I'll leave it up to my fellow panelists to tell you if any of those things which haven't yet happened will happen in 2023, but that's where we start the year.
Wow, Justin, that's super interesting. And all this detail is really helpful because we don't really get this in general. Just certainly looking at statistics, which show obviously last year was down globally in terms of deal flow. It did feel, and I'll turn to Michael Butler on this question. It did feel like there was a difference between the first half of last year and the second half, probably because of what was going on with rates and the potential recession. What to you were sort of the biggest surprises of last year, and just things that you noticed that were differences between 22 and 21, Michael?
Yeah, no, thank you, Randy. So what we saw a lot of choppiness, for us, and just to set the stage, we focus on the lower middle market. So our client base are companies between 100 million and 750 million. What we saw was a pretty good Q1. We then saw the bottom fall out of the market late April, May, June, July. I mean, it really, really became bearish. We had a lot of deals that just stalled or died. Then we saw a little bit of a comeback in the market in late August, September, after Labor Day, and a lot of the deals that had been stuck started to move forward. Um, Once we got to November, we had a lot of deals that were scheduled to close by year end. What happened was the buyers retraded. Almost every deal that we had in the market in that kind of early to mid November timeframe got retraded on. Most of them have gotten done. A few have slipped into this year, but most got done. So it was an extremely, extremely choppy year. I think the biggest surprise, Randy, was just the rollover of technology companies. Right? They hit a wall at 3,000 miles an hour. What we saw was technology companies were selling painkillers, things that buyers needed to have, right? Just mission critical software. They did okay. They weren't doing great, but they made it through okay, and those deals got done. Companies that are selling vitamins, nice to have software, but not critical software, just rolled over, and all those deals we had market just died. The other thing we saw was a lot of resiliency in the food and ag sector. Our ag practice was our largest practice last year. I think in an inflationary environment, ag assets are a good protection, and so we saw a lot of activity there. We saw good activity in industrial services, right? Things that had a recurring revenue nature to their business. I agree with Justin. There was selection bias, right? What we saw was the very best companies getting their deals done at good valuations. So the A deals got done. The B deals had very little interest, and the C deals didn't make sense to even take them to market. So we saw that same selection bias in our part of the market too.
Fascinating. And just following up on that, which is so helpful to dissect, particularly on sector to sector differences. We continue to see that as well going into 2023. And maybe Brian McDonough, turn to you. You've heard from Justin and Michael about what happened in 2022. Talk about a little bit current activity level. We saw on the lending side, unlike 2020, early 2022, where there was very little deal flow that flopped over from the end of 21. There seemed to be a rush to the exits at the end of 21. Not so much in 22. Kind of a little bit of wait and see, and we had a pretty significant amount of deal flow flopping over into the first quarter, which is healthy. What are you seeing in terms of current activity levels? Similar kind of haves and have-nots in terms of deals getting done and not getting done so far.
Yeah, great to be with you, Randy, and with my other colleagues here. Echo a lot of what Justin and Michael said. I think while 2022 was off epic highs of 2021, and depending on how you count it, the U.S. M&A market was still the fifth or sixth best in history. So there was a heck of a lot still going on in 2022, even though the markets became significantly more choppy as we got into the year. But again, to echo some of these parts, it's really a tale of two markets right now. There's still a tremendous amount of activity happening, but it's really dependent upon the quality of the company you're selling, the sector you're in, and the size of the transaction. As Michael just said, the A and A plus assets terms of quality are still very sought after. Buyers are still competing with each other to pay, 2021 type valuations in many cases because of a shift away from lower quality assets. The valuations have certainly held, if not strengthened. So good assets out there are still attracting attention, still attracting historic level valuations because there's a tremendous amount of capital out there that needs to chase deals. And that's continuing. The B or B minus assets, much harder to sell if the buyer is willing to take, or the seller is willing to take a meaningful valuation discount. Those deals can get done. And as Michael also said, anything kind of below a B minus, you probably best to wait to take that to market. The sector rotation has clearly happened. It's very difficult to get anything consumer discretionary or cyclical industrial done right now. But we've got plenty of other sectors, distribution, MRO related businesses, certainly healthcare, tech, and the more resilient end user markets of traditional business services are still attracting strong interest. So what you've seen is certainly a lower level of activity, but the activity maintaining relatively strong levels because of that shift away from the lower quality, kind of more cyclical assets towards those other assets. The other challenge is size. It's very hard to find the financing to do a $2+ billion deal these days. The 250 to kind of billion and a half market is still very attractive. Those deals are finding a way to get done. So it is really a tale of two cities. There's a lot of activity going on, but it's not for every deal. It's not for every deal in every sector, and it's certainly not for every size of deal.
Interesting. Thank you. Let's turn Adam Gifford to you.
Just add to what Brian said by pointing out that he's totally right. And if you start looking at deal activity by size level, what you see is the smaller the size you look at, the smaller the degradation in activity level, right? The middle market companies are remaining saleable for a variety of reasons, as their large cap brethren are not.
Interesting. Adam Gifford, what do you think? You've got a couple of issues there: sectors, size of companies. What changes have you seen, and why do you think that's happening?
Thanks, Randy. So I sit in Lincoln's industrial group, so much of my perspective is going to come from the industrials lens. To piggyback off of Brian's comments around activity, Lincoln Industrials was up from a transaction volume perspective in 2022 versus 2021. So I think we have a good perspective and a good pulse on the dynamics of the industrials market playing out in real time. Interestingly, we had an industrials meeting earlier this week, and we went through sort of our healthy backlog of deals and really wanted to do a pulse check of how this backlog of businesses was really performing. And the results of that pulse check was that 75% of our industrial businesses in our backlog were either strong or seeing stable business performance. So that means only 25% of the businesses that we've been hired to represent and take to market, we're seeing weakening or softening performance. So as others have sort of indicated, we're sitting in this very unique period of time where we have a lot of really good performing businesses that we're not ultimately exactly rushing to market yet as we let the dust settle here at the beginning of the year. I think if I could touch on sort of two areas of the industrials market that are very, very much bright spots, it would be that the first segment is the power segment of the market. We have a very active energy and power practice here at Lincoln, and the strength of this segment was very evident in 2022 and continues to be very active as we fill the calendar here. There's a multitude of demand drivers for these types of businesses. The billions of dollars from the Infrastructure and Jobs Act bills that were passed, the electrification, the investment into the power grid, where these dollars are going to go. And then there's, micro concepts like grid hardening, making the grid stronger against weather events, fire events. I mean, think about California, for example. And then really the biggest driver is the need for power and more power everywhere. We have more devices, more electric vehicles, more connected products than ever. So this increased need for power is causing additional stress on the grid. So to echo Brian's comments, across the industrial landscape, not every subsector is performing well, but energy and power and mobility technologies, electric vehicles, and all the technologies and products that go into electric vehicles are very strong. And those are businesses that, regardless of what the lending environment looks like, the strategics are paying up and are paying strategic prices because those businesses are growing year over year. And those strategics are also seeing their own businesses perform well, and most likely their stock prices and multiples perform well. So they can be a little bit more aggressive in this market, regardless of what the macro picture looks like.
That's super interesting to dig down deep into those sectors, because that's the kind of information that we're lacking. Let Adam Tyndall, let's turn to you. I'm in Europe talking to investors, and kid you not, the number one question I'm getting is about sponsor valuations and middle market M&A for, deals. Do we think that they are going to be coming down in concert with public valuations? And I'm sure people are looking at tech as an example of some of that dislocation and wondering if that's going to happen. From your seat, what do you think is going on with valuations? There's obviously the haves and have-nots in that equation. Outcomes we talked a little bit about, but if you could start maybe with what you're seeing from your seat on valuations, that would be interesting.
Yeah, happy to. Thanks for having me, Randy. Pleasure to be here alongside the other panelists as well. Look, from my perspective and from our perspective, valuations have come down. They've softened. To Justin's point earlier, hard to see that manifest itself in the data yet, because we are seeing that where valuations come in materially lower than expectations. You're seeing a lot of those sale processes get put on hold. In other words, sellers are choosing not to transact if they aren't compelled by the valuation of offers in front of them. Similarly, we're seeing a pretty big backlog of deal activity building, where sellers have hired an advisor, but are simply waiting to see, waiting for conditions to improve before launching a sale process. So that's one of the things I think will be very interesting to monitor over the course of the next 2 or 3 quarters is, when does this backlog of activity start to release itself? And I think a lot of that comes back to the financing markets, which I know we're going to talk more about. Clearly, we're living in a higher rate environment right now. How is that impacting deal activity? Is that benefiting buyers and processes? Look, you've seen base rates go up by 350, 400 plus basis points over the last 12 months. On top of that, on average, spreads have widened to the tune of 100 to 200 basis points. And on top of that, fees at closing have increased as well. So LBO financing is certainly a lot more expensive today than it was 12 months ago, but it's not just the cost of debt financing; it's also the quantum of debt that's available. And comments have been made thus far on the call about the availability of financing, especially for larger deals. But look, we're seeing term sheets from direct lenders in particular that are a half a turn lighter on leverage at best, and in some cases more than a turn lighter on leverage, and certainly due to interest coverage considerations, but more importantly, just recession fears and lenders' focus on downside protection. So clearly, that's impacting valuations. I do think it's also giving strategic buyers a leg up in this market, absolutely. And of course, that's sector specific. But we're seeing a lot of larger corporate buyers with healthy balance sheets and access to debt financing under existing credit agreements. So I think in the year ahead, it'll be fascinating to see how strategic buyers perhaps try to capitalize on this environment to be more acquisitive and more competitive than they have been in recent years.
And Adam, I'm back. Apologize for jumping off. So one of the questions, I guess, relative to that is, do we think interest rates, and we can talk about this later, but are we going to see a peak in the middle of this coming year, and then perhaps slightly coming down, or do we see this being potentially problematic for getting deals financed in the second half of the year?
Well, it's $1 million question. I personally think rates will peak this year. Obviously, everyone's very, very closely following inflation data week to week, but it appears that the Fed is starting to get that under control. Of course, they have to thread the needle relative to the rate environment and not going too far. But we're optimistic relative to where interest rates are heading and what that would imply for middle market M&A activity.
So, and just as a reminder for our poll questions and our for those of you who are haven't yet answered those 3 poll questions, go ahead and start to answer those, and we'll look at those answers shortly. Adam Gifford, talk about, just again, thinking about from an interest rate perspective, which is clearly driving financing and to some extent, obviously, the middle market activity. What could change in your mind in the potential scenarios that investors and practitioners should think about for the rest of the year? What won't change, and what are the things you're looking at to make a determination one way or the other?
Yeah, no, thanks, Randy. I mean, this is obviously a very timely topic as folks, come back from the holidays here, and with everybody here on this webinar, as we're speaking with our clients, we're having that daily conversation of, do you take your business to market today? Do you wait? If you wait, how long do you ultimately wait? To answer the specific question is what will change, what won't change, what's going to give all of us as advisors in the markets confidence to launch good businesses into the market. I think if we start with what's not going to change is interest rates. The SOFR curve peaks mid-year around 5%, and then declines back to 4.5%, where we are now by the end of the year. So no expected change, and likely going to get a little bit worse before it gets better. The further out curve suggests that rates will normalize around 3%, which is still far above the pre-2022 period. So as we think about fixed charge coverage ratios, interest coverage, it's going to continue to limit the quantum of debt for individual companies. And it's our hope, it's our belief that this will moderate in 2024, but likely not return to 2021 levels. So as we think about things that aren't going to change, it's the rate environment for the medium term here. What are the key indicators of things that we're looking at that will change, will give us more confidence as advisors to give our clients good advice? The first is the economic picture, the recession. Are we in one? Will we be in one? If we're in one, how long, how deep? We seemingly should have more clarity here in the next handful of months. And the hope is, that what was uncertain will not be uncertain anymore. And therefore, lenders, advisors, businesses will have more confidence to launch deals or to underwrite deals with more confidence. I think something to keep in mind too, from an indicator perspective, is default rates. Default rates, I think, are expected to increase to 3 to 5%, which is a meaningful increase than what it was in years past. And if ultimately those rates, increase as expected, or maybe even a little less than expected, then maybe lenders will view their portfolios as more resilient and begin to be more aggressive from a lending aspect. But on the flip side, if the default rates spike higher than anticipated, then maybe the reverse is true, and they may retrench further. So I think, the recession, the macroeconomic picture, default rates, some of the statistics and data, those are the things that we're keeping in mind as we look forward in 2023 around interest rates, around lending, and really around deal launch timing.
Interesting. So there's really still a significant amount of uncertainty, in the markets. And one of the questions that we also get asked is regarding, given that uncertainty, the outlook for fundraising generally, and particularly, Brian McDonough, the outlook for private equity fundraising. I've heard several versions. One is from the sponsors themselves, that we expect to raise pretty much at or higher levels than we expect in the funds that we expect to launch in 2023, albeit it will be slower in getting to those numbers. and then I've heard that some others are putting off fundraising because of the environment. Where do you stand, and what are you seeing in terms of those issues?
Yeah, well, actually, good to actually see you now, Randy. So that's terrific. Just maybe one piggyback comment on Adam's point. To me, what's going to change and when will the deal activity or the environment for sell sides be more attractive? It's pretty simple, right? If you don't know how a target company is going to perform over the next 12 months, you don't know where rates are, you don't know what it's worth. And unless you've got a seller who has a sense of what his or her company is really worth and a buyer who can put a value on it, it's very hard to transact. So as these companies over the next 3 to 6 months, as the economic conditions settle down, rates at least stabilize, I would agree they're not headed down, but they're going to stabilize. View on recession is going to become more clear. I think buyers and sellers will have a better ability to know how a company in play is going to perform over the next 12 to 18 months. They'll have a better sense of what valuations really are in the market. And when that happens, Katie barred the door because all these deals that have been waiting to come to market or who were suspended in 2022 are all going to come rushing back to the market at the same time. And we're going to see this enormous flurry of activity once those market conditions are in place. I don't know when that's going to happen in 2023. My suspicion is the earliest is the second part of this year. But when that happens, I think everyone on this phone is going to be busier again than they've ever been. From a PE fundraising perspective, the punchline is it's not easy out there right now. What happened in 2020, late part of 2020, and all throughout 2021 is all these GPs spent all their capital on the big bounce back in the deal market. And they came back or planned to come back to the market to fundraise in 2022. And the market conditions were very different. You saw the LPs being overextended from a PE perspective. You saw this so-called denominator effect with the drop in public market valuations. The LPs were upside down on their exposure to various asset classes, and the distributions through sale of companies by the PE firms back to the LPs dropped dramatically. And the combination of all those things with a huge demand for LP capital, a lower supply, and then all of these trends really caused a bit of a logjam in the PE fundraising market. Certainly, many funds got raised last year, but it was only the best of the best. And that continues here into 2023, where it's going to be very difficult for a lot of PE firms to raise capital in a highly competitive environment. The bar for top quartile performance went way up given the exits in 2021. And there's a lot of firms out there that are in a tough spot where they've spent all their capital and they're going to be challenged to compete in the deal market until they raise that new fund. And when and the prospects for their success in raising that fund are questionable. So we've actually seen a lot of deals where we've had name brand PE firms who've been in business for decades who actually didn't have the capital to complete the deals that they were chasing in the late part of 2022. And I'm sure all my colleagues saw this in their deals as well. It was an extraordinary situation where you never thought whether brand name PE firm X actually had the equity to do the deal, but it's a question you had to ask. And it's a question you had to diligence because of this exact environment. Now, we expect this to kind of moderate as we get further into 2023, but it is a real issue, is a real question. It's also impacted the secondary GP market, continuation vehicles and the like have been choppy as well with the supply and demand between the number of CV deals that are trying to get done and the amount of capital out there from institutional investors. So it's still choppy waters in the PE fundraising market for the foreseeable future.
Well, let's open it up to the rest of the panel because this is a very different kind of conversation that we're having now versus the kind of conversation we would have had last year or any prior year that I remember, certainly since the Great Recession. Panelists, anybody else want to comment on this? I mean, this could be one of the bigger changes and impediments to deal flow if we start to see real friction in fundraising, because we've been so used to seeing a significant amount of dry powder. That number is roughly 500 billion, 600 billion, give or take, of undrawn, unplaced, uninvested capital by private equity firms. Anyone want to take another angle on this topic?
I'll start. I agree with Brian. Everything he said, I think, is consistent with my own experience. Although I'll make the comment that the issue he describes affects individual firms and individual transactions, and I think he's right. We've probably all seen similar things, but it's not at the stage where I think anyone would say there's simply a shortage of private equity capital in the world. I think you're talking about things that can affect sort of a micro situation, but from a macro level, with a 3 to 5 year kind of fundraising cycle for some funds, some of them are a little shorter than that. You're not going to get massive impacts immediately. Certainly not the same way you might see them in some of the more liquid capital markets when fund flows really predict deal activity pretty directly. And I think that's an important fact to remember.
So, taking the long view on this,
and also, Randy, if I mean, with an historical lens, I don't think private equity fundraising is going away, candidly, until we fix the pension system and pension underfunding. And that's a really big macro question that I don't think we have the political will or ability to fix. So I don't see, while I think you'll see bumps in private equity fundraising, I think the long-term trend line is going to look pretty consistent over time.
That's my sense as well.
Randy, I might add just a couple of points here, because I agree this is a very important sort of topic area for 2023 for all of us. Around fundraising, if you talk to our private funds advisory team at Lincoln, I think what they tell you is they do expect to have a challenging year, as Brian said. There were a record number of fundraising activities in the market in 2022. The dynamic that they ultimately saw were a lot of funds that were missing their targets, and therefore were staying open open in a longer period of time than they normally would. And then from the LP's view is, they can be a little bit more choosy, or they were a little bit more choosy, where they had sort of 1 to 2 open spots. The example that we'd sort of give is if a private equity group was going out and wanted to raise $2 billion and ultimately only got $1.5 billion, it affects how much they can do from a deal standpoint. And ultimately, they have to increase their co-investment market. The continuation vehicle aspect is really a really interesting piece of the market. 2021 and the first half of 2022 were very robust in that market. The second half of 2022, similar to our sell side market, was challenging. There was just a bid and an ask spread that was oftentimes too broad to mind the gap. What's interesting is you have a lot of these deals that were done in the 2014, 15, 16 timeframes at private equity groups. Are the partners still there leading those investments? And if they're not, the value differentiation between that bid and the ask may not ultimately make a difference, because GPs are getting bonus points from LPs for returning capital in a very tough market. So from the CV aspect, there are some certain situations when it has to do with portfolio company timing of the initial investment and really getting those bonus points for returning capital to their investors.
Interesting. Justin, let's stick with you on digging into the M&A process a bit. So we talked about financing challenges. We talked about some of the issues with specific sectors, the haves and have-nots. What are you seeing in terms of structures and processes that's different given the current environment. How are valuation gaps being bridged? How are financing gaps being bridged? What are some of the give us some inside baseball in terms of all that.
Yeah, it's a great question and a very relevant one. I think that people are rediscovering what I'll call the old rainy day playbook. At least people my age are rediscovering it. I think some of our younger colleagues are discovering it. And in a word, I think that playbook is, as you said, is structure. I think that valuation gaps have been bridged increasingly through earnouts. Those earnouts are increasingly common. They're also increasingly complex. It's not just if EBITDA is greater than X, then you get Y. Sometimes they're pages and pages long. Lawyers have been deployed. It looks sometimes like a bunch of nested if-then statements. They can be creative. We love, by the way, when we're selling a business, when one of the guys on this panel show up on the buy side, because we know that there's going to be creativity and thought put into this sort of thing. It's very helpful. Second, you have these decreases in available debt quantums, unless that's debt quanta. And those of you who have opinions about which it should be, please email those to Randy, not me. Those are being supplemented, the decreased debt quanta, often by seller notes. Some of us will remember seller notes from, I don't know, like the Bush administration or something. You'll see some of those plugging, something like 5 to 10% of enterprise value in deals increasingly. Maybe they look a little bit different from the way they might have looked a generation ago. I think you'll see more of them float instead of fixed, but it's an old technique being redeployed. Third, I think you'll see the use of preferreds and other securities that have some sort of structural seniority. That's more and more common. And I suppose I can talk about a fourth kind of structure. I guess this is sort of structure, which is interesting, and that's the emergence of capital structures supporting buyouts that feature the reemergence of our old friend, the term loan A. Those structures, for those of you who are old enough to remember, have real amortization. They tend to have lower leverage. They have actual covenants. They have other things which long ago we decided were sort of irredeemably square, like pleats or cuffs on men's trousers, but they're back. And what I've not seen, by the way, is sort of a GFC style strategy, which was to do deals either by strategics or much more likely by financials entirely in equity, and then back lever them after the fact. I think that term loan A structure is basically an improvement on and a replacement for that. People are employing those structures in the assumption that they'll refinance them later in regular way institutional markets when those markets open up again. But in aggregate, I think these tools are important building blocks for M&A today.
So just to expand a little bit on structures, Justin, we're seeing sort of the return of the PIK preferred as a way to bridge. Senior lenders will take you only so far. Mezz can be expensive in this environment, doesn't help your interest coverage. Are you seeing more interesting kind of holdco convertible to, or PIK potentially convertible to cash pay at some point in transactions, maybe minority deals, things like that?
I think the short answer is yes, and some of this has to do also with the blurring of growth equity and traditional buyout strategies. Oftentimes, the same firm now is performing both of those types of investments through different pockets, and there's been some sort of cross fertilization of technologies, if you were, which is I think interesting. I should also say that it's not uncommon for traditional buyout firms to have raised over the last half dozen or so years a separate structured equity or minority equity pocket. So that's something you're seeing as well.
Interesting. Anyone else on the panel want to weigh in on structures and processes and predictions for how the first half will go relative to the second in that regard?
Yeah, Randy, I just comment. I totally agree with everything Justin is saying. We haven't seen it yet, but I think it's coming. And we talk a lot as a leadership team at BlackArch about how, as advisors, we're going to have to be scrappy this year. We're going to have to be creative, and I think that look, both buyers and sellers are going to at some point going to need to come to the table, especially in the first half of the year, with a willingness to engage on more creative structures. I think one interesting aside to that is that I think, at least from what we've seen, it tends to be the private company sellers where those structures are more palatable. In other words, family founder-owned businesses that don't yet have institutional backing, and that's a trend that we actually are paying close attention to for this year as well. Where, as is often the case, there are other goals and objectives that will serve as a catalyst for a sale process for a family or founder-owned business above and beyond just value maximization. So I think where we have seen more structured proposals, and I think where we will continue to see more structured proposals that actually get traction with sellers, perhaps could be with those private company sellers.
Let me just piggyback onto what Adam said. We see the same thing with family business owners. Probably right now, 90% of our business is with entrepreneur or family-owned businesses, and there's very often a lot of reasons why a family business owner will sell other than maximizing valuation. We're seeing a migration from the West Coast, right? There are a lot of business owners on the West Coast who want to leave the West Coast, need to sell their businesses. There's a lot of business owners who feel a sense of mortality with COVID. And so in those type of situations, there's a willingness and flexibility to look at structure, to look at earnouts, look at seller notes, to bridge the gap between bid and ask.
I always take Michael's comments on migration from the West Coast particularly seriously, because I think he's addressing us from his Texas office right now.
I voted with my feet.
In terms of the let's just think about the quality of transactions which you were talking about. Does that change if we start to get a improved economic outlook in the second half, with the Fed saying either threatening to ease or thinking about easing? Do we see, because we know there's a lot of capital out there, do we see a change?
I think there's going to be, if rates start to stabilize, I think everybody has huge backlogs. There's going to be a rush to market, right? There's going to be a plethora of deals in the market. I think, though, the buyers will still focus on quality, and it will be sector specific. I mean, we're not seeing bids in technology and consumer. It's industrial, it's food, bev, and ag. So within those sectors that are in favor and rotating appropriately, I think you'll see buyers stretch a little bit, maybe to A-, B+ deals, but I don't think you'll see them stretch for the B, B-, D+ deals.
So this is super helpful. Let's move on to something which I find fascinating, which is corporate earnings. So we have a index of our own portfolio companies and how well they're doing. We call it the Griffin Index. We haven't published it. At some point we will unveil it, but I know Golub has an index that's quite interesting, and they came out publicly with the performance of their portfolio, and it seems extremely strong. And I think they were a little surprised how strong it was. Frankly, I was surprised how strong ours was. So we're seeing similar strength in certainly middle market in companies with good industries. What do you think? And obviously, Wall Street's looking hard at public valuations and public earnings, looking for signs of weakness. What elements do you think are affecting corporate earnings now in the businesses that you're trading? And what do you think in terms of the outlook going forward?
Yeah, I'll take that, Randy. It's Brian. Look, I think Adam mentioned it earlier with his industrial commentary. We've faced a lot of headwinds in the last 3 years at this point. The initial COVID dynamic and shutdown, supply chain issues, inflation, geopolitical dynamics, interest rates, the reverse COVID bump, on and on and on. It's been a little bit like whack-a-mole, right? Where one of these issues starts to stabilize and another pops up. The issue we haven't faced yet is sluggishness in earnings. It's been amazing through all of those challenges how most companies in most sectors have continued to perform extremely well. The question is that going to change here in 2023? And, I personally think you have to keep listening to the Fed. For whatever reason, the market doesn't believe what they're saying. The Fed is saying we are going to get inflation under control at the risk of recession and at the risk of hurting the labor market. And to the extent they are serious about that and they continue with their path, I think that dynamic in terms of headwinds on earnings for some of the companies that we're hoping to bring to market in 2023 are going to be a potential challenge. We're going to have a number of companies, if we go into even a soft landing recessionary environment, there's going to be a number of companies here in certain sectors that don't have the continued momentum in top line or earnings in order to be successful in the market. To Michael's point, it will still be a buyer's market in the sense that buyers will be able to choose the companies they end up going after here. And I believe there's a real scenario where a lot of the 2023 expected exits for some of these companies are going to be pushed out to 2024 and beyond because the Fed's medicine is going to start to take effect over the next 2 to 4 quarters. And a lot of the companies we're hoping to sell or take public are not going to have the same momentum they had in the last 2 years. So the new mole that could potentially come up that we can whack down is this corporate earnings sluggishness. You're seeing so many public equity research analysts now saying that corporate earnings forecasts for the public companies are way too high for 2023. And therefore the valuations in the market aren't quite right. They're too high, if you will. So I really think that's something to watch. And our hope is that won't happen, of course. But my fear is we're going to have a bunch of these companies when the rest of these market conditions stabilize, we're going to think we can bring back out to the market. And if they start feeling those headwinds of the Fed intentional impact to create some type of recessionary environment to control inflation, some of those companies are going to face challenges. They're going to have to wait longer than we hope.
Interesting. Any other panelists want to weigh in? That's super helpful and interesting.
I'm probably slightly more optimistic than Brian, possibly out of some ignorance, but it seems to me that there are a lot of factors that are going to bolster corporate earnings going forward. Some of them are sort of macro themes, reshoring the industrial base, detangling, supply chains. These are major themes that are going to play out, have primary effects and secondary effects through a number of industries. I also think the biggest economic mystery of the last 2 decades or so, I mean, this is the biggest one at some level, is why has technology not created more productivity gains? And I think the answer is that it has, but they're latent in the system. Some of them aren't measured right for technical reasons that I barely understand, but have spent a little time trying to figure out. And some of them are, some of them just take time to play out. So I think there are some strong underpinnings. So I'm a little bit more optimistic, but I'll also make the comment that the private ownership, I think, this is a personal opinion, is a superior governance model to public ownership. I believe that. And I think that in periods of transition and uncertainty, and I think my fellow panelists have been very, very good at highlighting some of the causes of that uncertainty. I think the efficient frontier between those two ownership models shifts in favor of private ownership. So I think there are a lot of businesses that would go public in normal environments that will not, and that will drive the M&A market as well on the margins, and even companies that currently are public that should not be, that will also bolster that market. So I don't disagree with what I've heard, but I think that there's some reasons for optimism to temper those views.
Thank you. This is super helpful. I was busy scribbling and taking a bunch of notes. I'll have to watch this whole thing again. It's been so much content. Let's Before we wrap up, we only have a few more minutes. Amazingly, this hour is going by super fast. Let's take a look at the poll results. I'm very curious in Mr. Abelo's response with his family, and we're assuming, Justin, that having either a severe cold or flu and COVID is not equal to nothing but fun. So we're assuming that these are exclusionary categories. But it looks like people are, were pretty sick. And I would put myself in the, well, my family had COVID and the flu, and I think I had a severe cold, but we all had nothing but fun at the end of the year. So let's go to our next poll question. So this is one that I wanted to put up because I got a question from I think it was a sponsor or an investor, which I historically, I remember in the 06, 07 timeframe, we were really forcing sponsors to hedge their liabilities and any kind they took on significant amount of debt, requiring them in the credit agreement to hedge at least 50% or so. Sounds like 40%, at least from the survey, are finding that borrowers are not actively hedging. But let's see, 2059, so almost 60%, so almost 2/3 are. So that's actually pretty interesting and consistent with what I'm hearing. So that's great. I'm not sure if lenders are requiring it, but that's good news for investors. And
Randy,
then the last question,
Randy, if we
having to
sit
do,
on
I
this,
believe, with interest rates. Sorry, recession outlook. Yippee, soft landing. That's what I like to see. These are because our 600 plus attendees are all lead left subscribers, and so they are getting the best access to the best information, best thought leadership on the planet, which is why they all know that we're headed for a soft landing for the most part. We do have a smallish group, 25%, probably friends of Justin Abelo, who believe that this will be a hard landing. And then no recession at all. Let's see. I don't know. Who some Adam Tyndall's friends, maybe? I don't know. That's a brave bunch. No recession for next year. So that for this year rather. So we all are rooting for that. We'll see what happens. So we're 6 o'clock, but I wanted to give each of the panelists kind of a opportunity to just wrap up, and question for each one of you in turn: what one thought would you want to leave our attendees to keep in mind for 2023 as guidance with at the M&A market? What one thing do you want them to take away from this conversation today? And Justin, let me start with you.
I will probably punt to some extent by quoting myself from a minute ago and saying that I think that this is the time where smart, focused private ownership will really distinguish itself and produce alpha for investors. And I expect this is going to be a terrific market for private equity investors, and that we will see private equity in the second half of this year reassert itself in the M&A marketplace.
Excellent. Michael Butler?
Yeah, I think if you're a seller today, you want to be prepared to go to market when the window opens. I think when it opens, it's going to open wide, and a lot of people are going to try to get through. So I think you need to take the next quarter or two to really prep yourself for that time.
Great. Adam Gifford?
Yeah, I think Adam Tyndall talked about it, where this is a market that is not going to be easy, and a lot of creativity and scrappiness is needed. So I think sort of the firms or advisors that ultimately will kind of differentiate themselves and be able to provide their clients with the best advice are those that have different sort of product sets and services. So instead of middle of the fairway sell sides with no structure, the advisors that understand the structure elements the advisors that have continuation vehicle individuals, the folks that have capital advisory expertise. Those groups that are sort of one firm across product sets and service sets. I think those are the folks that the clients are really going to come to trust and lean on during a very challenging year.
Excellent. And Adam Tyndall, your last.
Yeah, I would just say, I mean, it seems to me that consensus amongst this group is that it's Q2, if not Q3, before the market opens back up. I would tell you that this is somewhat self-serving. I think for really high quality businesses with good recession resistant profiles, you can get a lot of eyeballs on a deal right now. I think especially coming back from the holidays, a lot of investors are eager to get back to work, and that doesn't solve for everything we've been talking about relative to the financing markets and just economic concerns. But just want to leave you with the fact that if you've got a good asset, there's plenty of capital out there, and relative to, for example, the end of 2021, where it was really just hard to get investors' attention and everybody was really overwhelmed. I think there's real scarcity value for high quality assets right now.
That's great, gentlemen. We are out of time. But once again, you have managed to pack in an amazing amount of information for our Lead Left subscribers. I want to thank you each, Justin Abloh, Houlihan Lokey, Michael Butler, Cascadia Capital, Adam Gifford, Lincoln International, Brian McDonough at Baird, and Adam Tyndall at BlackArch. Thank you for your time. Thank you too for our audience. We will be sending around a recording of this, and we will edit out the technical difficulties. So appreciate your patience with all of that. Have a healthy rest of your year. Stay tuned for additional Lead Left Presents webinars. They will be coming your way. And for all of you out there, stay safe and healthy. And congratulations on everything you guys have done in your businesses to grow. And let's wish everyone a great 2023. Thank you.
You're here.
Fantastic.